All right. Well, welcome everybody. Very happy to have you all here today and with this event, this ABCK, in conjunction with WeFact Consultancy and in collaboration with the AmChams of Qatar, Bahrain, Oman, and Saudi Arabia. We're pleased to invite you to today's tax seminar for U.S. citizens overseas. It's one of those things that all of us need to pay attention to, and it's an ever-changing world. So we're very, very fortunate to have Dr. Nabil Alexander with us today to discuss a lot of this tax things that we all are quite concerned about. So let me tell you a little bit about Dr. Nabil. Dr. Nabil is a graduate from Boston, the Boston College for Law School. He's licensed to practice in Massachusetts, New York, and Connecticut. After returning to Kuwait in 2016, he helped establish Integrated Tax Solutions in Kuwait, which is focused on providing services related to U.S. taxation of individuals and corporations. Integrated Tax Solutions also consisted with U.S. immigration issues such as green card and U.S. citizenship applications. In 2019, he joined WeFact Consultancy, which is focused on providing management, financial, and legal advice to both individual and corporate clientele. As a member of WeFact, he continues to primarily provide advice to individuals and corporations regarding U.S. tax, U.S. immigration, and U.S. corporate law. We're very, very fortunate to have him with us today. We're fortunate to have him as a member of ABCK here in Kuwait. And without further ado, I'd like to turn it over to him. Thank you.
Great. Thanks, Frank, for the introduction. And also thank you to the rest of the ABCK staff for putting this all together. And thank you all out there for giving me your time this afternoon to discuss taxes. Not exactly the most riveting issue out there, but as Frank says, there are definitely concerns and issues that people need to look out for. So without further ado, we're going to jump right into the material. We're going to go through the presentation, and then if there's questions, I'll take some of those at the end. Yeah, so the first question generally is, who is obligated to pay US taxes? In general, the IRS says that US persons, not citizens, need to pay taxes. US persons come in a variety of categories. As you can see here, there's several categories for what a US person is. One of those is citizens. Citizens are either born in the United States or they're naturalized. Green card holders are also considered US persons, even though they don't have full rights as a citizen and are obligated to pay taxes. In addition, if you have significant business interests in the US, if you're making money from the US, for instance, if you have rental properties and you're earning money from those rental properties, or if you have a business, maybe selling tools or something like that, that you're earning money from revenue, or even if you just have primarily stocks in the US earning various dividends through various means like that, any of those situations can potentially obligate you to pay money to the IRS in the form of a tax return. As you can see here, there's a few minimums in terms of the obligation to file taxes. So for a single filer under 65, that's just an individual person that's not married, they would have to earn at least $12,400 a year in order to have the obligation to submit a tax return. Keep in mind that the standard deduction from the IRS is roughly about $12,000. So someone that was making this amount of money would not really be obligated probably to pay anything at the end of the day. If you're over 65, the amount goes up a little bit, it's $14,050. And then for couples, generally, you will double the initial single filer under 65 amount. So in this case, $24,800. So as a rule of thumb, you can just generally double what a single person would have to report. And as far as the couple goes, that $24,800 applies to the couple's income in total. So it's not so I guess if either one was making $24,800 or combined they were making $24,800, then you would be obligated to file a tax return. Okay. In regards to couples, there are a couple of things to watch out for. There's a topic here which I'm not going to cover today, which is head of household. It's a bit ambiguous because it involves having one person being the primary earner, and it's a specific situation with requirements. However, the two primary areas here are married filing jointly and married filing separately. Now, in the case where you're married filing jointly, essentially you and your spouse, assuming that your spouse is also a US person, a green card holder with a social security number or otherwise a citizen, all your information is gonna appear in one tax return. The IRS prefers this, and so they give you the max amount of benefits in this regard because it's less paperwork for them generally. The other category is generally married filing separately. There's some situations where, for instance, maybe one spouse wants to file early and the other one's still maybe waiting for some documents for their income or something like that, where you may end up having to file taxes at different times. So the IRS does not like this. It's more paperwork for them. They have to look at two different returns. They don't know when they're going to get all the information in. So you actually will get less benefits here. It won't be necessarily, it will still be more than if you were a single filer, but generally it's less preferential, and they do take away a little bit of the benefit because you're filing separately in order to encourage you to file jointly. One thing to keep in mind is when you're going through the process of putting together your tax returns is in the States, a US person is obligated to file by April 15th. Assuming that that's in a weekday. If it's April 15th lands on, say, a Saturday or a Sunday, then it'll usually get moved over. For instance, this year, I believe it was April 17th. And because of Corona, the IRS has actually pushed back the filing deadline to May 17th. If you are overseas and a bona fide resident, and that means essentially that you have lived overseas for at least a year or more, and you can essentially claim overseas residence, you get an automatic extension from the IRS for 2 months. So normally your filing date would be June 15th. So anyone that's listening to this seminar that's living in anywhere in the region generally would not have to worry about actually getting their tax return submitted until about June 15th this year. Unfortunately, the IRS has not said anything about specifically this year moving that date back for Corona reasons. They have moved the domestic deadline, but not the international one, which they have done in the past, but it doesn't seem to be the case for this year. It should be noted that the April 15th deadline does apply also to the overseas returns, because if you don't file by April 15th and you do actually owe money to the IRS, they will actually accrue interest from that point. So whatever the compounded interest for the IRS is for that year, if you haven't paid by April 15th, you will actually have to pay a little bit more, even though you won't actually be late. And regarding late payments, they have failure to file penalties and some other penalties, but they're usually based on a percentage of what's actually owed to the IRS, right? So, I mean, at the end of the day, if you owe $20 to the IRS, they're not gonna fine you more than you owe. I mean, you might end up with like a $2 bill to the IRS or something like that. Even though it sounds a little bit silly, they're pretty rigorous about their numbers. Okay. Now, this is where things get a little bit tricky. So there are a few ways to prepare your first return, or if you're not really sure what to do with tax returns. Most people domestically in the States will use software such as TurboTax, which is just a pure software program. And it has a few different ways that it's set up, where it can ask you questions and kind of walk you through the process. People that are kind of comfortable with programs or just taking a stab at it themselves might use that. H&R Block is another avenue, and it is software related, but they actually also have locations throughout the United States. So they actually have it in tandem with their software. So if you say you were used to H&R Block software and then you had questions, you could actually either take your documents to an H&R Block or contact them by phone to kind of ask questions and have them walk you through the process. If you've never filed a tax return before, I would recommend that you actually go to a preparer, I mean, such as myself or other established preparers to help you kind of walk through the first return. And the reason for that is because if you make a mistake or an omission or any errors on your tax return, you are personally responsible for those mistakes. Even in the case where a tax preparer does prepare it for you, you are actually still personally responsible for it. You can also hold your tax preparer liable, and they will generally give you audit insurance and protection and maybe help correct the mistakes. But if it's just you without a preparer, then you will basically have to see how to sort out those issues on your own. We're going to get into the more international issues there. I was just talking about the basics before, but now we'll kind of get into what's really of concern for international citizens. And the tax preparing is one aspect of it, but for people overseas, there's a more significant issue. In 2010, Congress passed what's called the FATCA, which is the Foreign Account Tax Compliance Act. It severely increased scrutiny on U.S. persons overseas. Essentially, the IRS and the Treasury Department went to Congress and said, we believe that there are billions and billions of dollars overseas in unpaid taxes for U.S. citizens living there. And in order to really have some kind of enforcement of this bill, to have countries overseas have a mechanism where they can kind of actually go after U.S. citizens that are not complying, they added to this bill the foreign bank account requirement, the FBAR requirement. Now, this is where things get a little bit dicey for people that are overseas. I've had associates before call this a giant hammer to squash a very small bug. Essentially, the FBARs came about in the 1960s to catch drug dealers from Mexico. Mexican drug lords, or I guess they're people, were running across the border and depositing tons of monies into U.S. bank accounts. And the IRS, got a wind of this, and they said, okay, we need to do something about this. So they require any bank in the U.S. That receives payments of $10,000 or more to automatically report to the IRS. And this is what's being applied to foreign banks now. Right now, if you are a U.S. citizen overseas and you have an account with $10,000 or more at any given point, then you have to report that on what's called an FBAR report to the IRS to basically not have any kind of penalty. Keep in mind that they're not taxing this amount. Any amount that you report from these bank accounts is not something that they can take money for, but the penalties can be rather severe. So, for instance, if you're in Kuwait, I guess I will take as the example since we're here at the moment, and you have about 3,000 KD, which is roughly, I'd say, pretty close to a little over $10,000. And you have this account for 10 years, okay? And it's only ever had $3,000 in it. The Treasury Department can fine you $10,000 up to 8 years for this account if it was unreported. So the max for that one account is $80,000 over that period. If you had multiple accounts, then they can charge you per account in that regard. This also applies to the aggregate of accounts. So if you have two accounts, say one's $4,000 and one's $6,000 at the same time, and they both exceeding $10,000, then if you don't report those two accounts together, it can be considered a violation. Now those fees are generally only for if they consider that it was unintentional. I just accidentally, I'm sorry, I didn't know the rules, I didn't report this. In the case that they think it's intentional, the penalty jumps up to $100,000 a year per account, per year, up to 8 years. So $800,000 at the minimum, or 50% of the max of the account. And what that second part means there is if you have an account that has $1 million in it, and it's been sitting there, say, for 10 years, and you have not reported this account, the IRS will say, okay, you owe us $500,000 per year, so a total of $4 million for that one account. Now, keep in mind, for a lot of these penalties, you may not have that money, right? I mean, if someone has $1 million account, doesn't mean that they have $4 million to pay the penalty. Part of the way this actually came about is through UBS Bank in Switzerland in around 2010. Essentially, the president of UBS Bank, who the IRS had been after for a very long time, was traveling through the United States, had a stopover in Florida, The IRS raided the plane, arrested him, and put him in handcuffs, resulting in negotiations with the Swiss government. The Swiss government at that point decided that they would throw a bunch of US citizens under the bus, give up their bank account information, and give over all their financial details to the IRS. And it's basically led to the no secret banking in Switzerland for US citizens at this point. As a result of that, over the last couple of decades, while the amount of taxes they got from those citizens was pretty high, probably roughly around 200 million, the amount in penalties has at this point exceeded $1 billion. So whether they're actually going to get all that money or not, it's not clear, but at least in terms of penalties and the amount of revenue they're generating, that's just Switzerland by itself. So it's not really even accounting for other locations. Regarding the banks in this region, anyone essentially that has signed a FATCA agreement with the US government, Kuwait is a signatory, and several other countries in the Middle East are also signatories. The reason that they actually go along with this is in that agreement, for instance, with the National Bank of Kuwait, they have a branch in the US. If they have even one violation, that is even one single person who is a US person that's identified by the IRS, but has not been brought forth to the attention of the IRS by the bank itself can be subject to a 30% seizure of its assets in the US. So, I mean, that's a very high price that most banks are not willing to pay in order to protect basically anybody. So they're going to certain extents in order to try to flesh out who's a US citizen and then timely report that to the IRS. The two main forms you need to watch out for here. One is a W-9. Now the W-9 is not really an anything form in the US. I mean, essentially, if you're an independent contractor, you might use it. It's not really used for a lot of things other than just identifying it. It's essentially a half-page document with 6 pages of instructions. And you'll basically just fill out your name and your address on there, and generally a social security number. If you have not filed taxes and you've not filed FBARs, but you have actually filled out a W-9 with your bank, you might actually be in a situation where you've left yourself vulnerable to these FBAR penalties that I was discussing earlier. And the reason for that is because the IRS is going to get this document from the bank and say, oh, this person has a foreign account, but we don't have any tax returns and we don't have any FBARs related to this account. Therefore, they can start thinking of ways to apply that penalty. They can also put pressure on the bank to potentially close the account or freeze the account so that they potentially might be able to get those funds. Generally, sometimes if people have more than one nationality, they may also be obligated to fill out a W-8. The bank might say, here, just fill out this form and then we'll believe you. I cannot express enough how it is very dangerous for anyone that's a green card holder or a US citizen to fill out a W-8. It is actually a criminal violation to do that because essentially it is fraud before the IRS, and because essentially any document that you fill out with the IRS is essentially a sworn statement, it can also be considered perjury. Filling out a W-8 if you are a US passport holder or green card holder can definitely lead to potential jail time and definitely penalties in that regard. So in the case where you have to, or if you're forced into a situation where you have to fill out one of the two, it's definitely better to fill out the W-9. And in that case, you can always try to send in your information before the IRS gets a hold of it. Generally, if you can take a hold of, get your information into the IRS before they're made aware of your foreign bank account, which is very likely considering they are understaffed and underfunded, you can basically avoid those penalties. Here it is, I'll briefly mention a couple of things. One is, if you have a US employer here in Kuwait, some people, work with different military bases or different US employers that do actually issue W-2s and W-1099s perhaps. Those documents are submitted to the IRS. If the IRS gets those documents and they do not see a tax return, they will file a tax return on your behalf. They will basically decide, based on what we're seeing, we think you made this much money and you owe us this. And then if they don't get a tax return from you, it'll result to additional penalties and fines, which can add up. Now that directly relates to something that they did in 2015. In 2015, Congress essentially added to the issues by allowing the Secretary of State essentially to block any U.S. citizen who owes more than $50,000 to the U.S. government from renewing their passport. So if you're living overseas, your passport's expired, you owe more than $50,000 to the U.S. government, they will not renew your passport until you have paid that money to them, or otherwise gotten a release from the IRS in order to renew your passport. So the next part we're going to talk here is basically, all right, I've never filed taxes, or maybe I haven't filed in a while. If you've only never filed for 2 or 3 years or something, it's very easy to catch up. You can just essentially send in those years, and there really won't be many issues, especially if you don't actually owe anything. However, if it's been 6, 10, 15 years, I've talked to some people that haven't filed in a long time, there are programs for that as well. So the main one in this regard, and there are a couple, is the Offshore Voluntary Disclosure Program. Now, this does allow for total forgiveness. So for instance, say you haven't filed for 15 years, you've been living overseas. This will allow you to file 6 years of tax returns, 8 years worth of FBARs, and then a statement kind of explaining why that happened. So I mean, in some cases, people have just never filed before. And maybe they have 20 years where they've never filed, or 30 years where they've never filed. All those other years will be completely forgiven, and you just basically get a fresh start. Essentially, once all that material goes in, the IRS does have 3 years to review everything. If they come back, you have to provide any documentations, answer any questions they have. However, if after 3 years they have not said anything, the case is closed. The IRS is legally prevented from going back and ever reopening that ever again. So it is a very good program for people that are in a situation where they've just not been aware, or they really want to catch up and maybe got some bad advice. One thing in this regard is, I've talked to a lot of people that have come to Kuwait and said, oh, my tax preparer said, when I went overseas, I would never have to pay taxes because, it's just going to zero out. That's actually a misinterpretation of the foreign earned income exclusion. Now, this is actually very good news for anyone that's living overseas. The foreign earned income exclusion for this year is $108,700. That means if you earn $108,700 per year or less, that will completely get reduced to zero, as long as that's from a foreign source. If you're actually working for the US government overseas, that will not apply to you, but basically any other source, if you're a military contractor, if you're working with vectors or something like that, or if you're working for a foreign company, you can 100% exclude that income. Further, if you're have housing expenses, you're renting an apartment, that amount can actually go up to roughly $150,000 per year. So because you essentially get what's called a housing exclusion deduction with the foreign earned income exclusion. It's generally referred to as Form 2555. Now, unfortunately, some preparers in the US misinterpret this since it zeroes out as thinking you don't have to apply. The problem is, if you do not file your tax return, you are not actually getting the deduction, even though you may owe zero. The good news is, though, if you owe zero and you are late on your return, you can still file your return without really any worry about getting fined or penalized, because your taxable amount is actually zero. So there's nothing for them to tax or penalize. Before I get into stimulus checks, I will just also point out that the OVDP that I was mentioning previously is actually for people that more or less have no issues with their background. Essentially, if you are actually hiding money from the IRS, there used to be programs for that. They have since closed those. So it is for people that are really just kind of just really didn't know what to do at that time, because you do have to send in a statement. The next thing I'm going to cover real quick is stimulus checks, because a lot of people have been asking me about this as well. Regarding stimulus checks, they have been kind of newly approved due to the coronavirus. And pretty much anyone that is a US citizen is eligible for these payments, even if you've never filed before, or even if you didn't receive the payments previously, you're still eligible for those payments since they were previously sent out. So essentially, the only thing you really have to do in order to take advantage is essentially file your taxes. You have to be a US person. They did qualify it a little bit more going forward in terms of the income brackets, but as long as your income bracket is appropriate, all you have to do is just submit your tax return. And for last year, for instance, they did require that you have submitted for the previous year before that. So last year was 2020. The tax year for that was 2019. So essentially, it's always the year before. So for instance, 2021, the tax year is 2020. So in 2019, so last year for 2020, you had to have filed 2019, the current year, and 2018, the year before, in order to receive the payments. There were basically 2 payments issued last year at different times. If you are a single person, they sent out a check for $1,200 and then another check for $600. So your total for the year was roughly $1,800 altogether. Couples would receive, double that amount. In case where you have dependents, I believe the amount could go up as high as $900 or sorry, $700 per dependent added on that as well. And a dependent in the US essentially would normally be a child, and they would also have to be a US citizen. That is, they have a social security number as well. For this year, they have relaxed some of the payments, some of the rules a little bit in terms of submitting things. So some people did not get their payments last year. They might have gotten the 1,200 or the 600, but not both. So they, for instance, one of the questions for this year on the tax return that they added was, how did you receive a payment? And if you did, how much did you get? And for instance, if you say I received 1,200, they will send you another $600 check. Or if you owe taxes, they'll actually apply that to the amount that is owed. And the payments are generally just triggered by submitting tax returns. For 2021, as long as you submit your tax return, the payment so far is $1,400. Next slide, please. So now we're just going to talk a little bit about the logistics of actually getting the stimulus payment if you're an overseas citizen. There's generally just a few different ways to go about this. The first one is on your tax return, you can actually use a US bank account. It has to be a US bank account because it needs an ABA number, and you also need to include the routing number for the US bank. And that can go directly on your tax return. If you do that, the IRS can directly deposit that amount into your bank account. The IRS also has the option of sending you a certified US bank check, and also sending you potentially a debit card, which they did in a few cases, but not too many. The debit card I have not actually come across myself, so I'm not really sure how it would maybe be applied overseas. I don't think that they would send it. In some cases, and I'll talk about the USPS here in a second, because if the IRS does send you a check, they will send it through the United States postal system. For many of you living overseas, if you use a foreign address and that country, for instance, like with Kuwait, does not have a good infrastructure for the postal system where it matches up with the US, you most likely will not receive the check. One of the things that the US government was doing in order to make sure people did receive their checks was to send this amount directly to the US Embassy here. So the US Embassy was contacting people in order to tell them, hey, we received your stimulus check, you can come in and pick it up. But that's only if they had contact information. Generally, the checks issued by the IRS are good for 1 year. So if you receive it at any point in that 1 year, you can try to cash it in. If not, then there are avenues to try to apply for it again. So in the case that you are trying to receive some sort of stimulus check here, the best ways to do it is on your tax return itself. to use a U.S. postal address if you have one. Put your U.S. bank account information there. Or if you have a family or friends, someone there that's able to receive it on your behalf, you can use their address on your tax return. The primary address on the tax return is a mailing address. So it doesn't really affect, your overseas status or any of those deductions. It's just where you receive your mail. They understand that, so that's not an issue. And then with regard to if you receive a check, for overseas, for instance, here in Kuwait, at least, because they have a branch in the US, they are able to cash checks from the US Treasury, from the IRS. And I had a couple of clients do that successfully. Like I said, I don't know about the debit cards if those were issued, but it is possible to essentially receive those checks in Kuwait and cash them locally if you're not able to do it in the US. And then I think we're on to our last slide here. And I appreciate everyone for listening with regards to all the tax talk. I know it's not that, it's a lot of information, so we will be open up here for questions in just a minute. Just a quick word about my firm. As Frank mentioned at the beginning, we do offer financial, legal and management services, consultation services to individuals and corporations. And that's, not just for Kuwait, but around the region and also in Europe and the US. And we also recently got licensed by CADIPA. So in regards to any company that wants to operate in Kuwait, we are able to offer kind of some superior incentives. One of them, which people have been asking for a long time, is they allow for 100% ownership of the business within Kuwait itself for any qualifying company. This allows basically, you don't have to worry about a lot of the headaches of, maybe, working with someone else or something like that on the local level. CADIPA also allows, they do all the paperwork for all the ministries, all the running around, all the hiring, and then everything essentially is streamlined through them. So we'll go to the last slide here. I really appreciate all your attention, and I think we can start taking some questions here, Paula.
Thank you so much, Nabil. So we have quite a few questions. The first one being, is payment required by the 15th of April or just postmark if it is sent via registered international mail?
That's a great question. So because of what's known as the mailbox rule in the US, if you postmark something by the date that it is due, it is considered submitted by that date. So as long as it is postmarked by the 15th, whether it is international or domestically, it is considered submitted by that date. So even if it's international mail, registered mail, as long as it's sent by April 15th or this year, April 17th, it'll be considered as sent on time. Although if you're living overseas, you do have until June 17th.
Thank you for that. And about the companies issuing the W-2, what if your foreign company does not issue them? How does the IRS know what you've earned?
So all tax documents are basically an honesty test from the IRS. If they don't issue a W-2, there are additional ways you can report your income. For instance, one of them is did you just receive cash from your employer, right? So if you're paid in cash, you are obligated to report it. Essentially, the IRS takes everything at face value. Whatever information you put on your document, they will consider that to be true. If they find out that you've lied on your documents or misled them at some point, that's when you are subject to criminal penalties and potentially garnishment of wages, seizure of assets, anything they can really kind of get their hands on at that point, and potentially, like I said, jail time, because it is a federal crime to lie on your tax returns.
Thank you so much. And then we have another question. A gentleman says, my wife gave up her green card last year because we're not living in the US. She still has her social security number. Can we still file as married jointly?
She no longer has her green card, you said?
That's right. She gave up her green card, but she has a social security number.
Yeah, so because she no longer has her green card, the social security number probably will be expunged from the system. So you no longer would be in a position to file as married filing jointly, and I would not recommend that you do so because there's no, if you did file with that number, potentially they could see it as fraud because there's no basis for her having the social security number at this point. So I would be very careful with that at this point. You can actually file married filing jointly, just not with the social security number. You may not necessarily get all the benefits because the social security number won't be there, but it's not an issue to report. You can still put your spouse on the return, you just can't use the previous social security number.
If I may please add something, you would have to file a W-7.
You can file a W-7. The W-7 is for getting a social security number. So there has to be a reason for applying for the W-7. The W-7 is normally for people trying to file a one-time tax return or something of that nature. If you wanted to file it continually or every year, I would not recommend a W-7. One, it takes a long time for them to process, especially at this juncture. And the second point is that if you do file the W-7, they're not expecting you to file again with that necessarily. So most of the time what they're doing is they're giving you a very temporary number just for the purpose of filing one return. Most of the time you'll see a W-7 with regard to real estate transactions.
Thank you. And then someone is saying that they had their green card in 2010. They never returned back to the US, and therefore they did not file for the IRS. So what can they do now?
Do you still have your green card? I assume there's an expiration date on it. I guess it's a little bit complicated for that one because I don't know what the intention of the asker is, whether they're trying to reapply for a green card or what the motivation is, because if it's already expired and they have no intention of returning to the States, I wouldn't necessarily worry about it. It was essentially a temporary situation. The IRS could quibble about those few years that they were a green card holder.
So
generally,
he's actually mentioning that he does still have the green card. It's still a valid green card.
It's still a valid green card. Yeah. So in that case, you would probably, because it's been, quite a while since the issuance of that green card and it's still valid, you would probably want to take advantage of, for instance, the Offshore Voluntary Disclosure Program and kind of explain why you hadn't filed for those few years and catch up on those back taxes. Unfortunately, it is a situation where if you are planning on going to the US at some point, they are going to say, hey, where are your tax returns? Where is your commitment to trying to become a US citizen? So for green card holders, especially, filing taxes is important because it affects, the citizenship test or evaluation at the end of the process.
Thank you for that. And then for foreign earned income exclusion, does it apply if the income comes from a US company for work done on their behalf overseas?
Yes, absolutely. The only sources that don't count for the foreign earned income exclusion are government sources. So for instance, if you're working for the embassy or directly working for the US military, say as a soldier or employed directly by them. But if you're just a contractor, if it's just a US company that's overseas, then even if they're paying you with a W-2 or 1099, whatever the case may be, the foreign earned income exclusion absolutely applies to you as well.
And someone is asking, would you please clarify the housing exclusion? I understood it was up to $16,000 in the past. Has this changed?
Did they say 16,000?
Yes, that's right.
Okay. Yeah, no, it is significantly higher at this point. So both the foreign earned income exclusion and the housing allowance in there, both are increased for inflation every year. I believe roughly the total now is between $50,000 or $60,000. I would have to double check the exact numbers, but most people never use it up all the way. And there is kind of a cap on it, but it is significantly higher now if you're thinking about something from maybe 15 or 20 years ago. It might have been that low, but it's definitely increased quite a bit since then.
And we have another question. It's a little unclear to me. How do you determine the amount that you declare to the IRS that is in the foreign banks? Is it the amount on the particular date, or is it the highest amount during the calendar year?
That is a very good question, and it's also a very tricky question. So basically, if you have for even 1 second, and this is the best way, I mean, a former IRS associate basically explained it this way: if you have even for 1 second a balance that exceeds $10,000, at that point, it triggers your obligation to file the FBAR and report that balance. So say, a family member sends you $10,000 and you immediately transfer it away. It's only in your account for a second. For that 1 second, because your account reached over $10,000, you have to now file an FBAR for that year. That also applies to loans and other amounts of money that are not income. Like I said, because they're not taxing this balance, because you're not going to owe any money on this amounts that are in the bank account, they are just asking for disclosure. So it does not matter what the source is. It does not matter what the time frame is. If you hit over that $10,000 limit, at that point, you're obligated to report for the year.
Thank you for that. And then if you file as a couple, the 108,000 deduction, is it multiplied by 2?
Absolutely. Yes. Happy to say it is.
Perfect. And then, sorry, as a follow-up, if one of the spouses is not a U.S. person, can we still file as a couple? I believe you already touched on this, correct?
Yeah, you can still file as a couple. It's a little bit trickier, especially if you're going to use any kind of software, because it doesn't really want to recognize the fact that the other person doesn't have a social security number. However, what you're essentially doing at that point is reporting your spouse. And like I said, without this actual second social security number in there, the benefits won't necessarily double. You won't get those necessarily those deductions. But overall, that person is not going to be taxed either. So their income doesn't necessarily have to be reported on the return. You're just basically saying that I'm married and I have a spouse and this is my full information.
Thank you. And Chester is asking, was there a recent change to the AMT?
Okay. There have been several changes because of the new tax law, including to the AMT. It basically is amended a little bit year to year, especially with regards to the amounts. So, for instance, on the lower end of things, because of the new tax bill that was passed a few years ago, many of the lower end deductions used to be able to deduct legal advice, tax preparation services, some moving costs, some other smaller general costs. You are no longer allowed to deduct those. You just get one large standard deduction, which I think right now is around $12,000. So there have been a few changes to the AMT, although we'd have to get into the specifics of this, specifically what he's looking for in that regard. So it's a bit of a longer conversation.
Thank you for that. And then, do students in the U.S. that are receiving foreign scholarships are they required to file, and are they subject to owing the U.S. government money?
There's two things there. One, it depends on if the student is a U.S. citizen. So if they are a U.S. citizen, it could potentially be considered some kind of income. However, if it's a grant from a foreign government, that is technically foreign source income. And if it is a grant, it may not necessarily have those strings attached. If that person is a US citizen and it's not a particularly large grant, they can very easily just declare it under any of their earnings and it'll be wiped out by the standard deduction. If it's a larger amount of money, there are a few technicalities, but there are ways of basically saying, look, this is foreign money and it is money from a specific sovereign, so it is not subject to the US taxation regulations. Also in the fact that if it's just money for education, it may not be considered income outright. So if it's not income, then it's not taxable.
Thank you for that. And someone is asking, can you please advise, if you have never filed for FBAR, what is the earliest time when you can file? And also, do you need to file FBAR for yourself and any corporate accounts as well?
Yes. So the FBAR applies to any account in which your name appears if you're a US citizen. So even if it's a corporate account and you have some signatory authority over that account, or even if you're just a holding for that account, then you have to file for that account an FBAR. As far as the time frame, generally the IRS has extended that to, or the Treasury Department rather, has extended that to October of every year. If you have a few years of outstanding FBARs, the best way to go about it is to do what's called a delinquent FBAR procedure. Basically, you take the part from the offshore voluntary disclosure where you're filing 8 years of FBARs and you just file the FBARs for 8 years. As long as you also have tax returns for those years, it'll just basically be submitted. And like I said, as long as the Treasury Department or IRS doesn't have any inquiries about those accounts beforehand from W-9s or something, then you should be fine to just basically submit those FBARs all at once and then not really worry about the consequences after that.
Thank you, Nabil. And so this is a question about dual citizenship. There are some locals that are also US citizens. And you understand that the government does give them money, for example, if they're working for private sector. So are US Kuwaiti citizens receiving money from the government on top of their salary? Should they also file, or should they include this in their filing of the taxes?
Yeah, that is something that has come up quite a bit. In general, for our clients, we have been reporting this amount most of the time because it hasn't really increased them to the point where their foreign earned income exclusion is exceeded. So they're able to basically declare all of it all together and then still essentially pay zero in taxes. Obviously some people are in a slightly different situation, but in general, because there's no way to essentially disqualify it as some kind of income, we have been reporting it for most of our clients.
Thank you. And can you please advise in regards to inheritance incomes or funds?
As far as inheritance?
Yes.
So as far as inheritance taxes in the US goes, the person that is leaving the money is the person that's taxed. So the estate is normally taxed. If, for instance, you are a dual citizen and you are inheriting from, say like, just to use a Kuwait example again, like a Kuwaiti father or something like that, then there's not going to be any tax on the person receiving, and there won't be any tax on that person's estate because they're not a US person. Even in the case where someone is going to be taxed, the estate, say that they are a US person, a US citizen, and they're leaving money, the estate by itself has to value over $2 million before it can be taxable. So most people are never really going to have that question. It's only if you're receiving money from a large estate, then the estate has to worry about the inheritance taxes. But the person receiving the money is never taxed.
And then we have another question. You mentioned the exclusion for overseas earners, which is 108,000, but then you mentioned something about 150,000 if you have a rental. Do you mean overseas or in the US? Can you please explain? Thank you.
Okay. Yeah, no. So we're talking about overseas housing in general. However, if you also have a property in the United States or property somewhere else, you can actually also deduct the fees associated, maybe even the mortgage and interest associated with those properties. So especially in the States, if you have mortgage interest and things of that nature, all those are deductible items. Any kind of local taxes or maintenance fees that you're paying are also deductible. For your overseas housing, I should say, I mean, even if you have a purchased house, it doesn't necessarily have to be a rental. The rent that you're paying overseas is part of the housing allowance. So say, you're paying 1,000 KD a month for a place, or $1,000 rather, and it's $12,000 a year for the apartment. Then that $12,000 would be completely deductible. And then any costs associated with that as well. So, you had to pay someone, an electrician, to come in and redo the place, or you had to completely, paint it for some reason. And there's costs associated with repairing either your lodging overseas or locally or both. All those are deductions that you can put against any money they might owe the IRS.
Thank you, Nabil. And one last very important question. How can a private individual reach you or your company to help them file their taxes?
The best way right now is to reach out through ABCK. They have my contact info. Unfortunately, I did not put any information here. There's also our website, wafak.kw.com. All of us are listed on there. You're definitely welcome to email us through there to get in touch. Otherwise, yeah, I would say, probably get in touch with the good people of the ABCK, and I'm sure they'll be able to put you in touch as well. So, we definitely look forward to helping everybody that we can.
And then one last question. What are the current percentages taxed for the different tax brackets? For example, someone that makes 200,000 versus someone that makes 300,000. Do you happen to know this? And if not, is there a website that they can go to see the bracket?
I would recommend essentially, even if you just go to Google and just IRS tax brackets. Every tax bracket. And keep in mind that if you're overseas, even if you are owning $200,000 or $300,000 a year, if your foreign income exclusion brings that number down to say like 150, 160, that number, that reduced number is your gross income, and that is what you are taxed on. So you won't be taxed on the bigger number, it'll be the smaller number after all the deductions, and then that's considered your gross income, and that's what's actually taxed.
Thank you so much, Nabil. And then I think now it's time for the surprise raffle.
Yeah.
So WAFAC has very graciously offered a raffle for one-person consultation session. Let me see 1 second. I'm pulling out the winner. Okay, and the winner for this is Reem's iPhone. So Reem, please get in touch with us by email, and we will provide you with Nabil's information as well, so you can get in touch with him.
Oh, congratulations, Reem's iPhone.
Thank you so much, Nabil. So I think that's the time that we have for the questions for now.
Great. I appreciate everyone setting this up, and thank you for your time and all the questions. And I hope to hear from anyone that has any questions. Please feel free, like I said, to reach out to the good people at ABCK.
Thank you, Nabil. A good presentation, buddy. And thank you for Paula for directing this. And we wish you the best of luck, Nabil, all the time.
Thank you.
Great.
We'd also like to thank everybody that participated. There was quite a few people involved today, and this is the most questions I have ever seen in any presentation since I've been doing this, which just shows how informative this was and how much a lot of us have learned from this. I've been overseas for 17 years, and I learned something new over all of this one. So thank you, Nabil, very, very much. Very informative. Excellent presentation. Please, for those of you that continue to have questions, reach out. We'll get you to Nabil and to his company so that you can coordinate with him to learn a lot more. Your consultations with him. Clearly evident that professional help is definitely needed in this area. Again, I thank everybody for participating. Nabil, thank you very, very much as always. We appreciate it very, very much. I look forward to seeing you in person sometime soon. And all of you have a wonderful, wonderful day. Thank you very much.
And thank you. Thank you.